Power pricing. Pricing your services may just be the final frontier, the final thing that a lot of us have to figure out how to overcome. It's the final obstacle that a lot of people are still struggling with in the accounting and bookkeeping profession. How do we price our services? How do we change? Everybody's saying that we need to get out of the hourly pricing model. And there's an important distinction between pricing and billing, and that needs to be well understood before we can even have this conversation. Pricing is what you do initially. You decide what it's going to cost your clients to hire you for your services. Billing is what you do long after you've established your pricing, and if you're billing after the fact, after you've provided the services. So it's important to understand the difference between pricing and billing. So when we talk about value pricing, that's this concept that a lot of us are talking about. There's a lot of buzz about, where we're really going to a flat rate pricing model. But there are more implications under the heading of value pricing that also need to be understood. And I don't agree with all of them, which is why I've sort of formed my own concept that's very similar, and there's a lot of overlap to what you're calling value pricing, but I call it power pricing. Value pricing, and here's the essential distinction between sort of my version of it and what you're learning about in terms of value pricing, is that value pricing suggests that you price things based on the value of the output. And my concept of power pricing differs in that I feel that puts too much power in the hands of the customer or the client to decide what the value is. And they have no clue. It's too subjective. And in their perception, in three different clients' perception, you're going to get three different opinions about what that value is. Whereas I feel that the power should be in the hands of the consultant who's providing the service to decide what that value is. And more than that, there's a true scientific formula behind what the value actually is, what you can charge for your services, and it's not really based on value at all. It's based on supply and demand, because you and I can offer the same exact thing. When you break down the list of services that we offer, and maybe even the output looks substantially similar, right? But I might be able to charge more than you if I have gone out into the marketplace and created more demand for what I offer. And based on that, people will be willing to pay more for me to do the same thing versus paying you simply because I've created more demand for what I offer. So power pricing to me is really, it's based on supply and demand pricing, and it's based on going out there and doing the marketing that you need to do to create the demand in the marketplace wherever it is that you offer your services and whatever services it is that you offer. And really underlying all of this is the fact that we're both, my concept and the value pricing concept are completely in agreement, is on the idea that you have to get away from the hourly pricing model. And you're looking on screen at a clear demonstration of why that is. In short, pricing hourly means that I'm at odds with my client, right? Because I'm going to want to bill a lot of hours to make more money, and the client's going to want me to bill as few hours as possible so that they don't get a huge bill, right? And the reality is the output's theoretically going to be the same. So here's the next part. If from year 1 to year 2, I get better at my job because I go out there and I spend hours and hours learning how to use apps and other tools that help me get more efficient, then the number of hours it takes to get the same job done is going to go down. And in an hourly pricing model, the client benefits from that, which is great from the client. Clients are going to love that because their bill is going to get lower. But now I'm working, in a sense, twice as hard to make the same amount of money. And here's the illustration. So on an hourly model, let's say that the hours it takes in a year to get the job done for a bookkeeping client is 260 hours, right? Which is just based on 5 hours a week times 52 weeks. It's going to get me total revenue of $39,000. But if in the second year I get so much better at my job that I'm able to scale that down to an hour a week, now the same output, the same value that I'm delivering to my client only yields $7,800 in annual revenue. I lose $31,200 annually in an hourly pricing model because I got better at my job. That makes no sense. I should get rewarded for getting better at my job. When I'm employed and I do really well at my job, I get a raise. I get paid more, not less. Here, I'm in a sense getting demoted for doing a good job. On a flat rate model, by contrast, we get the same differential, right? The first year it takes 260 hours, the second year it takes 52. But I'm charging the same $39,000 annually because I'm charging based on the output. I'm charging based on what I'm delivering, right? Not based on how much time it takes me. And so look at the effective hourly rate. So in year 2, I get the raise for doing a better job. I get an effective hourly rate of $750 an hour. Now, that's like lawyer fees. That's more than lawyer fees. And that's the whole idea, is if the client was happy to pay me $39,000 to produce something, and I produced it, why does the client care how long it took me to produce that? The client shouldn't care at all, right? The client should only care that in the case of a bookkeeping engagement, they're getting accurate and reliable financial information that they can use to make decisions based on it, and that a tax prep professional can use to file a tax return that they feel confident in terms of the numbers being, again, accurate and reliable. And that even in the bigger picture, bigger than that, that between the bookkeeping professional, the accountant, the CPA, all of those people, and of course the business owner themselves, are able to use that information to make intelligent decisions about how to grow and scale that business. This, my friends, is what my power pricing webinar is all about. You've just gotten a taste. You've gotten the first sort of part of it, talking about pricing. Then we're going to get a little deeper into supply and demand pricing, and we're going to look at an exercise that will help you figure out how to come up with a flat monthly fee based on what you're delivering and based on, frankly, what's going to get you excited to do the work. So check wherever you're seeing this video for the description, for the links. We're doing power pricing your services for ICB, the Institute of Certified Bookkeepers, coming up Thursday, October 20th, 2016. I look forward to seeing you in the webinar.